Pay close attention. The next 30 seconds could make up for all your stock market losses this year and even save your retirement. On September 22nd, you'll have a rare chance to hear from two Wall Street legends, Marc Chaikin and Joel Lippman. Marc spent 50 years on Wall Street, where he worked alongside the likes of Paul Tudor Jones and invented one of Wall Street's most popular indicators, a stock picking system that appears on every Bloomberg terminal in the world today. His biggest fans include CNBC's Jim Cramer, who said he's learned the hard way never to bet against Marc. Meanwhile, Joel Lippman is a forensic accountant who spent the last 30 years denouncing Wall Street. He predicted the crash of 2008 months before it hit, and his insights are in such high demand, he's been invited to speak at Harvard, the FBI, and even the Pentagon. What Marc and Joel are going to share with you on September 22nd could make or break your retirement. A way to 5x your money, even if the market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes, depending on which side you're on. Let's face it, the stock market's been a minefield this year, with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't safe anymore. Your money's losing value even as we speak, at a rate we haven't seen since the 1980s. If you want to survive this disorienting market, then don't miss Marc and Joel's big reveal on September 22nd. They'll be giving you a financial lifeline that can erase this year's losses for you and trigger a wave of potential wealth that's so powerful it could save your retirement. And you don't have to wait until September 22nd to get started. For a sneak peek of Marc and Joel's big reveal, go to wealthcrisis2022.com. That's wealthcrisis2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is September 20th, 2022, a beautiful Tuesday down here in South Florida. We got a big show coming up for you. We got the Fed. They're already started their meeting. We'll talk about that, what the expectation is for that. And tomorrow, we get the actual number. What will Jerome Powell and his cronies do? Then we're going to talk about a billionaire who came out this morning and said he likes a couple stocks. We'll talk about those stocks. And then finally, the housing market. Some mixed numbers this week. We're going to dive into the housing market, what it means for the CPI, what it means for inflation, what it means for the market overall, and what it means for you. All that and more coming up right now on Making Money. Hello again, this is Matt McCall. Thanks for joining me. It's September 20th, 2022. A beautiful Tuesday morning, as I mentioned, down here in South Florida. Went for a walk to get my tea this morning. It was absolutely beautiful. I didn't break a massive sweat, just a small sweat. And that's, I think, a step in the right direction for the crazy weather that is down here, as it's my first summer fall in South Florida. But as I mentioned, we got a big show coming up for you. The Fed meeting is underway. The two-day Fed meeting, it's going to be Tuesday, Wednesday. And tomorrow, Wednesday, midday, we will have the decision from Fed Chairman Jerome Powell and the Federal Reserve. Right now, the odds are we're going to have a 75 basis point rate hike. That's 0.75%. There's about an 80% chance of that. There is, though, about a 20% chance that we have a 100 basis point interest rate hike, which would be a full 1%. That's somewhat unprecedented. So I don't see that happening. I would not really be too upset if they did. It's going to hit the market near term if they do, I'll tell you that much. But I wouldn't be too upset because I still believe that we're going to have a 75 basis point hike at the next meeting. So why not do 100 now? And then if we start seeing inflation come down and maybe the market sells off and the Fed gets scared, they do 50 next time. That could be actually a boost to the market. So it's almost like taking your pain now instead of kind of just prolonging it out. And, you know, as unprecedented as it is, overnight last night, I woke up to the news that Sweden, one of my top 10 countries to go to, Sweden raised their interest rate by 100 basis points. It's the first time that they made such a move since 1992. So as uncommon as it is something that was just done by an economy, or I should say a central bank, just this week. Again, I don't see it happening personally, but there is a chance. And a 1 in 5 chance isn't great, but it's not bad. It's not like looking at a 2% chance. We're looking at about 20%. And that number may change today as we go into tomorrow, but it's still there. So during this move up that we've had in interest rates, we've had quite a few big moves in the equity markets as well as the bond markets. We'll talk about stocks here in a moment, but I want to talk real quick about the bond markets and show you where we are right now. So I'm going to pull up a chart here, and this is a chart looking at the yield on the 10-year Treasury rate as well as a 2-year Treasury rate. The 10-year here is in purple, the 2-year is in orange. And as you can see, going back, this is a 1-year chart. If you go way back, the 2-year is trading or is yielding about 0.2%. 0.2%. It's now at 3.85% in 1 year. We had the 10-year around 1.45, 1.5. Now we're at 3.45%. So this is inverted because typically you're going to get much less, as you can see down here a year ago. We were getting much more of a yield out of the 10-year. Now it's the 2-year. And that typically is an indication of a recession. And we had that invert for the first time here. It did it for about a hot second back in April, but really fully did it in July. So a couple months ago. But I wanted to show you this just because of the magnitude of how quickly rates have gone up, which have led to the 30-year mortgage rate going through 6% for the first time in many, many years, which is hurting the housing market, which we'll talk about again a little bit later in the show. But I wanted to show you this because you have to realize, and I talked about this on the last show, and I've talked about it in a lot of my daily reports, which, by the way, every day the market's open, we put out a daily report, my team and I. We pick 2 headlines. We talk about it and what it means to you. Put some charts in there. Free. Every day the market's open. You can sign up for that at any point and just get that free in your inbox. So I highly recommend that, number one. Number two, as I mentioned, we talked about this a little bit, and just how yields go up, bond prices go down. So bond funds, I wrote about this on Monday in my daily insight I put out. Bonds continue to get absolutely crushed. Let me just show you something here real quick. This is TLT. This is the iShares Barclays 20-plus year Treasury bond ETF. You can see here today it's down another 1.5%, the lowest level on the chart. I could zoom out a little bit in the chart. You can see it's still, I need to zoom way the heck out, still keep going. I mean, we're looking out years, folks, going all the way back to 2014. And so TLT is at the lowest level since 2014. We hit a high in 2020 at around 180. We're down to 105 right now. So that's a massive, massive pullback. I mean, massive, about 40%, give or take, sell-off in bonds. And as I've talked about again a few times, the bond market right now, the U.S. bond market, is on pace for its worst year since the Civil War. So if you're sitting in bonds and it hurts, yeah, I get it. I mean, I'm not a big bond guy. It's just not in my nature. But I managed money for 17 years. So I had clients, obviously, that were at one fixed income. And I will say, majority of those 17 years, I had maybe 1 to 3%, if ever any, in bond funds and ETFs for this exact reason. If you're buying individual bonds, it's fine because it doesn't matter. As long as you hold on to maturity, and as long as the company continues to make payments, you get your yield to maturity that you locked in initially when you bought that. When you do the funds and the bonds, you get hit. So please keep that in mind. So reading this morning, Leon Cooperman, who I don't want to say I know, but I've been on set with him when I used to work at Fox Business and Fox News. I've sat next to him. He was on my show as a host of, and really nice guy, billionaire. And he came out and he was on in the media this morning, and he said 2 quotes here I just want to highlight. One was that the market really isn't cheap. Okay. The other one was, he said, it's a very strange market. The indices themselves have no destination for me, but I find a lot of individual stocks that are attractively priced. But I'm not expecting much in the market. So you could really analyze this if I was a psychologist, and I think you get a lot of things out of this, but it's a little bit of speaking of both sides of the mouth. But what I take from it is he sees kind of the market not really extremely cheap. It's like, okay, go throw darts and buy anything. He doesn't expect the overall market to do much in the near term. Kind of agree with both those things. But what he does see is opportunities in individual stocks. And I definitely see that. And a term on Wall Street that really annoys the heck out of me is a stock picker's market. And I really kind of think we're in a stock picker's market right now. So you have to look at stocks that are cheap, stocks that will do well in the next 3 to 5 to 10 years. And I think there's a lot of stocks out there that fall into that category. I also feel like there's a lot of stocks that don't fall into that category. I mean, take electric vehicles, for example. I think Tesla's a great 5 to 10 year hold. I think some of the legacy vehicle makers, the ones that have been around, legacy means Ford, GM, Chrysler. It's not Chrysler anymore, but Stellantis. Some of these legacy makers, Volkswagen. I think they'll do well also. And then you have some of the younger ones, the startups from Rivian and some of those. And I think a couple of those will do well. But I don't think everyone is going to do well. Every electric vehicle company out there right now. So you have to be really picky, not only for trading, which we're not doing here, but long-term investing as well. You need to pick the ones that are going to come out on top. And a lot of them will come out on top because that trend of electric vehicles, it may not go as fast as some of these estimates are, but gosh dang it, there's going to be a lot more electric vehicles on the road in the future than there is today. There's no doubting that. So I agree with Cooperman right now. Another fascinating thing that came out is he has about 22% of his stocks in energy. So obviously his fund's been doing fairly well. Three companies he mentioned he likes, and we'll take a look at these here real quick. One was Cigna, which is healthcare plans, health insurance. As you can see, great looking chart. I mean, considering what the market's doing this year, boy, oh boy, this looks fantastic. Another one that he likes is Energy Transfer Equity, symbol ET. Just phone home, don't forget. You can see longer term, this is kind of in a no man's land, but over the last year or so, again, trading near 1 year high. So energy has been doing very well. And the third one that he mentioned is Lithium Motors, symbol LAD, which is hitting a 52-week low today. And this is a auto dealership. And we've had car prices spike, obviously, in the last 2 years or so. And we have inflation, obviously. So people are slowing down on large purchases. But of those three, I mean, really, the healthcare plans just continue to do well. And that's just a stable business where you don't really see demand come down. The only thing that can end up hurting a lot of these healthcare plans over the long term is some type of regulatory change to any type of healthcare in the United States, which I don't foresee any time in the near future. And when it comes to energy, obviously, the demand for energy will remain, and a lot of the energy stocks still remain cheap, even with the run up that we've had in the markets or in price and oil. It's pulled back as of late, but we've had it, obviously, to run up. So I still see some opportunity in oil and gas, and I bought an oil and gas stock recently for myself in my portfolio, and I think there is definitely some upside on a pullback. A lot of these stocks have pulled back too to some nice support levels, so I see some upside. So Leon Cooperman, again, great guy. Had him on a show, met him a few times. And I have to agree. I think he's spot on, and he's probably kicking the butt of the market this year. I think he said he didn't say the numbers, but he said his fund was doing well this year. So good for him. So the one thing I wanted to really dive into here today is the housing market, and for a couple of reasons. One, there's been some numbers that have come out lately. Two, it seems to be a topic that I run into quite a bit in my travels and going different places. This weekend, Fred in town from Nicaragua went to another friend's house. We sat on the porch. I didn't have a stogie, but they were drinking bourbon and smoking cigars, and we were BSing for about 4 hours. I personally was drinking water and being a good boy, but I was still involved in a conversation, and it went all over the place. We're all in kind of a similar business, but housing tends to come up a lot, and it's an interesting debate, being down here in South Florida, because a lot of prices have held up pretty well because it's such high demand to move to Florida, obviously for weather purposes, for political purposes, tax purposes. And, it's a pretty good quality of life down here. So you do see people moving down here. While there's other areas that prices have really started coming down. So this morning we had housing starts come out, and they rebounded. This is August numbers, rebounded from the prior month, July. They were up 12.2%. So huge gain. And what's amazing is the estimate was for a gain of 0.3%. So blew the doors off what the estimates were. If you break down the numbers, it looks like a lot of that was due to the fact that they were multi-family unit housing starts. These aren't permits, these are actually starting. So as rents go up, what do people do that have money that build multifamily? They're trying to get more units out there to take advantage of the all-time high rents, which we're going to talk about that in a second. So that kind of makes sense. Uh, Within that number that came out from the Commerce Department, we also had building permits. And obviously, that's a step before the housing starts, getting the permit. That was down 10% in August, and the expectations for a decline of 4.4%. So maybe it's just lagging a bit here, but it looks like the housing starts will be down, which will typically lead to housing starts being down. But the mixed numbers didn't really say one thing really big in one direction or the other. And keep in mind, from month to month, these are quite volatile numbers. Early this week, we had the home builder sentiment come out, and that just continues to come down. The National Association of Home Builders, the NAHB, it fell to 46 from 49 in August. This is the September number, and the estimate was for it to be 48. So here's a chart, as you can see here. This is the NAHB Home Builder Sentiment Index going back to 1985. And that's where we're at right now, down at that 46 level. We obviously had a big spike down during COVID when basically everything shut down. So you kind of want to take that out as a bit of a black swan. But you go back to really when the housing crash began 07-ish and stayed down all the way through. And we didn't get back up to this number until about 2013. So about 6 years, well below the 46. So we're way off that level, the kind of these peak bottom levels of the housing crash, great financial collapse, and also a low that we saw back in the early 90s when we had a bit of a recession. And these shaded areas are the recession. So a bit of a area there. The other thing we want to look at, though, is kind of the speed at which this is happening. And the speed at which this is happening is what's pretty fascinating. The 6-month rate of change is now at 33. The only time it has been this worse than this, was 1985. Worse, since 1985. The only time since 1985, sorry, it's been worse than this was during COVID. And this has led now, the reason you're having such a fast pace of selling off is because this is the 9th consecutive month of negative numbers of declines. And here's a chart here for you. This shows that. And you can see going back to 85. We had spikes here in 06, 07, or 07, 08, I should say, when we had the housing crisis into the financial crisis, but it never hit 9 months. It had 8 months. This is 9 months. So we are seeing basically something that's unprecedented, where we're seeing it come down so quickly. And, that leads me to think about where the housing market goes from here. We've also, obviously it looks pretty ugly from what I've just showed you there. The home builder sentiment, which is the people that actually build the homes. If that's not good, that means that they're struggling a bit. As I just mentioned, building permits down down 10% versus estimate of 4.4%. We did housing starts up, but other than that, we're still pointing to some ugly numbers. We also the 10-year yield hitting a highest level that it's seen in over a decade. We have mortgage rates then basically based off that hitting levels we haven't seen in many, many years, above 6%. So it makes affordability drop. But we still see inventory low. So it's a mixed bag. However, the numbers are pretty damn ugly when it comes to housing. And we really haven't seen prices come down. So let me show you a chart here of rent and home prices. And you're going to be kind of blown away by this. And let's take a look at this. This is the Case-Shiller Home Price Index is the orange one here. And this is going back over the last year. Home prices up 13.31%. We don't have the most recent number yet, but this is 13.31%. And then you can see the US CPI. This is the rent of primary residence. That's up 6.3%. And remember, folks, shelter makes up 1/3 of the CPI, the Consumer Price Index, the inflation number. So when we have home prices up 13.3% year over year, we have rents up 6.3% year over year. Ultimately, our largest expense is shelter. That's why the CPI is 1/3 of CPI. And these numbers, we'll go back to this chart for a second, are still hitting highs. So these numbers are still hitting highs. As these numbers continue to hit highs, how does the CPI come down? Because it takes up 1/3 of it. If the CPI doesn't come down, how does the Fed stop being super aggressive in interest rates? So I'm kind of trying to tie this all back together with the Fed meeting tomorrow and going into where interest rates are now, breaking out to decade highs, and then tying it back to housing, and then tying this right back to if housing prices don't come down and rents don't come down, inflation remains high, which means the Fed remains aggressive. And one more chart here that I want to show you, and this is the CPI. And the orange line here is a CPI with all items. I'm sorry, this is the orange is shelter. The purple line is a CPI X shelter. So the other 67% that makes up CPI. You can see here how it dropped when shelter spiked. I mean, that's still a big move on the upside. So if we do get shelter down, you can imagine this CPI, the rest of the CPI number keeps coming down. That means the overall CPI number will come down. So let's tie this all together. If and when home prices come down a little more, if and when rents start to come down, that will lead to 1/3 of the CPI coming down, shelter. You tag that onto the chart I just showed you, which is a CPI with everything but shelter, already starting to roll over. You add that together, you see the CPI accelerate pretty quickly to the downside. And I'm not saying this happens next month, but I do believe because of the sentiment that we see from home builders, the permits dropping 10%, mortgage rates breaking out to levels we haven't seen in a long time, affordability starting to drop a little bit with such high prices, that we will see home prices come down. The one kind of wild card is people still have to live somewhere. I rent down here in Florida. I own in Baltimore. I own in Nicaragua. So I kind of see both levels. And rents are high, especially high in South Florida. Well, especially it's in season now too, but especially high, like ridiculously high. So if you're not making good money, you're going to struggle. And those high prices of rent, because there's such demand, because a lot of people can't afford the home they want in now, because interest rates have gone up so much, leading to their borrowing costs being much higher, when do rents come down? And I said this last week, rents are somewhat our canary in the coal mine. When we start seeing rents roll over, you'll see shelter costs roll over, you'll see the CPI roll over, and you'll see the Fed start being less aggressive. You add that all together, that recipe equals a rally in stocks. And I think this happens in the next 2 months. October, November, I think we could probably see a bottom in mid to late October. Mark Chaikin and I talked about this last week when I had him on the show. He thinks sometime in October. I can't disagree with him. He's a very smart man. He's been right for decades. I'm not one to try and pick a day or pick a time. I'll let the market dictate, and I listen to Mother Market, and she'll tell me when it's time. But the way things are pointing, and my kind of thesis right now does point to something potentially being bottom, sometimes bottom potentially being in October, November timeframe. So I just want you to keep that in mind, folks, when you're starting to look at the market and kind of what will be that catalyst to turn the market around. And, keep in mind, Leon Cooperman said that it doesn't seem the market itself being overly cheap here, but there are a lot of individual stocks that I believe look really good. And one other thing I want to take a look at while we're talking about housing, let's take a look at the housing ETF. Keep in mind these housing numbers continue to get worse. The interest rates obviously have broken above where they were in June, so making mortgage rates go higher. So you would think that the housing stocks would be actually hitting a new low as well. Let's take a look at an ETF here. This is the ITB. iShares Dow Jones US Home Construction ETF. It's still about 10 to 12% off the June low, which is pretty interesting because you would think, again, that you'd be breaking down. I think a lot of it has to do with, even though it's off the June lows, a lot of these stocks are priced really well. The other thing is, even though home builder sentiment is negative, there's still, a lot of demand out there for homes because we don't have huge inventory. We just don't. And eventually rents will push people to buy homes because they'll figure, heck, I had the down payment already. Might be a little bit more now, but I'd rather put everything I'm paying towards a house versus burning it and putting it up in the air with rent. So I think we will see that come back again, and that will have rent prices come down. And you take a look at some of the large home builders out there. Let's take a look at D.R. Horton, which makes about 15% of ITB. Symbol in D.R. Horton's DHI. Its forward P ratio is 4.2. Forward price of sales 0.8. And it's tough to kind of argue with the valuations you see. And I think that's why you're seeing a lot of these home builders actually hold up pretty well. So last but not least, let's take a look here at the stock market, at the S&P 500 here really quick. And this is still early in the morning. It's 10:52 here East Coast time. So it's market's only been open about an hour and 22 minutes. S&P's down just about 1%, well off the lows of the day, closer to the high today. After we had a rally yesterday afternoon, I think we'd probably stay right around here between now and tomorrow when the Fed does come out. Take a look real quick at the NASDAQ QQQs, NASDAQ 100. They're only down about 0.5% on the high of the day. So we are seeing some of the money really come back into the tech stocks. And we've kind of seen that a little bit when the market rallies. We do see the money come into it. Again, we're kind of in no man's land here. As I said last week on Thursday when Mark Chaikin and I sat down, there was a chance that we could retest the June lows. If that happens and it holds, I think it's going to be an amazing, amazing buying opportunity. We may not even test it. We may break through it, but I'll let the market dictate it. Tomorrow's going to be a really good indicator of what happens. It's going to be something that we will dive into. I'm going to write about it tomorrow in the daily. Again, if you don't get the free daily report, make sure you sign up for it. Every day the market's open, we put that out. And a lot of great insight. I try to share as much as I can and what's going on in the market that day or trends that we see that are affecting the market long term as well. But part of that tomorrow will be a breakdown of what happened with the Fed and my view on what we think that's affecting us as investors and consumers in the same. So, folks, we're going to wrap it there. But I thank you very much. And I hope you were able to understand the connection here and how important rent prices are. So however you want to follow them, just Google rent prices, follow them. I'm going to highlight them for you. Keep tuning into the show. But it's important that we keep an eye on that because that is our canary in the coal mine, rent prices. Keep that in mind. Well, I hope everybody has a wonderful week. We'll be back Thursday coming to you live here again from South Florida. But have a great week. Be safe. Go out there and give somebody a hug or at least smile. Spread some love in this crazy-ass world. Once again, thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.